Okay, grade 11s, let's cover the second part of your financial analysis. We've got 3 more indicators to just quickly go through for Module 7, which are specific to partnerships. First of all, earnings per partner. This is indicator number 7. Basically, what you're looking here at is the amount that each partner is earning separately. So you would take their salary for the year per annum, add the interest on their capital, plus if they have a bonus, and then finally, plus or minus their share in the profit, which is a plus, or if there was a loss, that would be a minus. So basically what you're doing is you are looking at your appropriation account, but just separately for each partner. Remember, the net profit, in this case 335,500, is first of all divided up for salaries, bonus and interest, and then the money that's left over, in this case it would have been about 48,000. Then you split that amount according to the ratio that they agreed upon, and that will go also to their current accounts. Next indicator is indicator 8. It's linked to number 7. You will need the answer for number 7 to do indicator 8. First of all, it refers to the personal investment of the owner specifically. So that partner can look at his investment and how has his investment grown. It's got a percentage connected to it. First of all, your equity is made up out of quite a few numbers, which will all be divided by 2 at the end. You'll first add your capital at the beginning of the year, the money that you put in, and at the end, and then also the current account is added to the equity. So what was the balance at the beginning and what was the balance at the end? Both these balances could be negative, and then you would obviously minus it, but you divide that answer then by 2. Then your formula will be amount earned, which is indicator 7, which we've calculated already for that partner. And then the average equity is as we just broke it down. And you will then get a percentage that must hopefully be more than what the return would be from an alternative financial investment. Lastly, let's look at gearing. Gearing is a term that will be connected to your indicator 6, so return on equity, not per partner, but let's say for the business as a whole. Something we do need to take note of, that it is favorable to make use of loans. What does a loan do? It gives you more funds to increase your profits or to grow your business. You can buy more assets or more stock and therefore have a bigger turnover. So, your debt equity ratio might state that you're at high risk, meaning your debt, your loans, are much bigger than the equity coming from the owners or the partners. But they're saying this could benefit the business in the long run. Therefore, you would have to look at gearing uniquely within each business and say high risk at this time is acceptable as the business is working towards something. See if the profits outweigh the interest expense. That will be your main focus if you want to comment on gearing. So basically, there's a percentage for your interest. Let's say the banks say, we'll give it to you at 12% per annum. But then you compare it with the return of the business and see, but the business return is 22%. And therefore, it's a lot more than what the interest would cost you. So if your interest is less than the profit, you can cover that cost, and therefore you'll comment that it's positively geared. So in other words, this percentage of the interest has to be less than your return. But if your business are making very small returns, let's say 2, 3, 5%, then it would not be advisable to make another loan because you won't even be able to cover the interest. Just a last note on norms. How do you comment on all these indicators that we've discussed? First thing, know that there's not one norm that you can apply to all business. Say it has to be 2-to-1 or 1-to-1. It varies from business to business. One example would be if a business just started out. You cannot say there's concerns for the liquidity or whatever. It must be a unique scenario because of the position that the business is in. Same applies for economic climate. Currently, because of COVID-19, we've got a very bad economic climate, and therefore these formulas, when you comment on them, you will have to adjust your answer. You can't be as harsh, because it will actually be normal that some of these formulas will not be looking that great. And then lastly, mainly what you will do with your conclusions or your comments is to do a comparison from year to year, even if you can get your hands on another business, and then compare those answers of your ratios with that. Well done, that's it.